Well, there's two realities that both inflation and the economy, global economy, are trending down. And those facts, one shouldn't obscure those just because of a bit of Fed speak or ECB speak. And that's what the markets are driving off. So this is a kind of reversal of last year. What happened last year is inflation was trending up all year, and central banks were kind of trying to catch up. And when they did catch up, they caught the market short. And obviously we had a difficult market.
You caught in the last decade, though, because the last decade meant that we had the Fed had our back. We couldn't bet against the Fed. We couldn't, in fact, bet against any central bank that effectively was going to do it, whatever it took, trying to get us back to some sort of inflationary environment. Haven't we changed gears? Aren't we in a Volcker-style environment now, that it is an environment where the strategy is to smash every little bit of inflation, no matter what the cost is?
I'm probably caught in the 1980s, so yes, you're right to remind me of that. Thank you. Now, I think the point I'm trying to make is that one shouldn't get too hung up on exactly what the Fed and the ECB are doing and saying. One should more look at the trends. And the trend is actually, the most important trend is inflation. Because if inflation goes in the wrong direction, if inflation goes back up again, let's say, then we know that sooner or later, whatever the Fed want to believe, they will have to come kicking and screaming.
But it doesn't even have to go back up again. It could just stay where it is and not come down again. That's still a problem.
That is indeed a problem. But the point I'm making is I think inflation is trending down. And actually, if you look at the oil price, which is a kind of nice proxy for a leading indicator, then the oil price is still even lower than it was a few months ago. We're close to the year's lows. We were at least a few days ago. So my base case scenario is inflation is trending down. We'll get down to the 2.5–3% in the US by year end. And that's what's driving markets. So where the Fed is at the moment, the Fed's talking, okay, skip, pause, who knows what. Possibly they'll go in July again. I don't think they will. But it doesn't really matter. What matters is inflation. Inflation. Sorry, Tony Blair. The economy, a bit more confusing. It's not fallen off a cliff, which is good news. There are bits of it which are doing reasonably well. The employment data, as we know in particular. Some of the other indicators are actually perking up a bit, which is good news. So the economy has shown itself to be reasonably resilient. Those higher wages that we've seen now for some time are filtering through into consumer spending. So it's been a pretty good cocktail, and there's the chart. There are the markets. That's what the markets reacted to. And my base point is that, look, we need to continue with this scenario. We're not at an inflection point here. And I see, if anything, quite frankly, we can continue in the second half and maybe see 5,000 at year end. I mean, it's hard to believe, but we are in a bull market, and we need to focus on that. Until things really change with the inflation data.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.